Welcome, friends. Today we will discuss profit and loss account, a case study based on the topic of profit and loss account. This is from your paper 1 ABM of your CAB exam. Now, before I start, I would like you to watch other two videos which would be useful before you do this case study. So you can watch this on our YouTube channel Stu-C TV. You will find this concept video, and then for further clarity, you can also watch our podcast. So these two videos, if you watch and then come to this discussion on case study, it will be easier for you. So let's start anyway. So the case study is an analysis of MNO Limited. It is a medium-sized manufacturing firm, and here we have a summary of its financial data and auditor's note. So we have two things, the financial data and auditor's note. Let's have a look at what is given to us first of all. So we see here we have profit and loss account. So there are various items of profit and loss account. So sales or revenue is given 1000, then COGS is given as 600, and gross profit, you know how it is arrived, revenue minus COGS. So then you will get your gross profit. So gross profit, as you know, 1000 minus 600, 400. And then if you remember the structure, so first you have sales, then expenditure, then gross profit, and from there you have operating expenses which is to be deducted. So which is basically admin expense, selling expense, salaries, all other indirect expenses related to your business. So this is 200. Then you will have depreciation 50. So once you deduct operating expenses and depreciation, you will now have something known as EBIT. So or it's also called as EBITDA, earnings before interest, tax, and depreciation. So this, if you see 400 minus 200 minus 50, so we'll have 150. That is your operating profit, also known by the name EBIT or EBITDA. Okay, then you deduct financial expenses, which is nothing but your interest payments. The company might have availed various loans, so interest payments towards those loans is shown as financial expense, again another non-operating expense. This will be deducted from the operating profit, and then you will have profit before tax. So this is 70, 150 minus 80, 70. And once you pay the tax on this profit, which is around 20 here, so you finally deduct 20 from the PBT and you get the net profit, which is the profit left after all your deductions. So this is the one which will be either transferred to balance sheet as retained earnings or distributed among dividend as dividend among the shareholders. Now they also have given you balance sheet. So you have fixed assets, current assets. So if you look at the balance sheet, as you know, there is liability side and asset side. So asset sides you have fixed asset, then current assets, so 600, and then 500 current assets. Liability side you have current liabilities, long-term borrowings, equity share capital, and retained earnings. So all this, if you see total, it comes, I think it is around 1100 here, liabilities and assets also 1100. So this is balanced. So this is the balance sheet data. And finally, you have auditor's note. So some important comments made by the auditors of the company. So they are saying that it is in agreement with the accounting principles. Then there is provision for depreciation and taxes. Then you have short-term borrowings were partly used for acquisition of machinery. This is kind of a red flag, because if you have gone through balance sheet, you will know that short-term borrowings are current liabilities. That means these are loans which have to be repaid in another 12 months. You have to pay them back within a short span of time. And now what they have said, that this fund, the short-term fund, was used for buying machinery, which is a long-term fund, long-term use, long-term use. So, and you will not get returns from this machinery immediately. So there will definitely be a mismatch. So it is always advised that short-term borrowings should not be used for long-term investment like machinery, land, and building, because they will not give immediate returns. Then you will have cash flow problem to meet these loan repayment. Okay, let's see what he says next. Sales return increased by 20% compared to last year. Now, what is sales return? That the customer has received the product, he has paid for it, but then he's for some reason he's returning it, and he's also indicating quality concerns in the product they are selling. So again, this is a red flag that frequently customers are returning the goods sold by the company due to quality issues. Then financial expenses compared to industry peers. So let's quickly have a look at the financial expense. If you look at, yes, this is the financial expense, which is a non-operating expense. So operating profit was 150, and from that, almost more than 50% actually is going for interest. So then they are left with only 70. So a big part of their profit is being used for interest payments of the loans they have taken. So more than 50% share for interest is huge compared to the other industry, compared to the other companies in the same industry peers. Now let's have a look at the questions. What is gross profit margin? Gross profit margin, you would know, is a simple formula. This is profit or gross profit divided by turnover or sales, divided by turnover or sales. This is the normal formula for calculating gross profit margin. So they have made a sales of 1000 and they have made a profit of 400. So their margin is 40%. So if they have got 1000 rupees in revenue, they are able to generate 400 rupees gross profit. That means almost 40%. So the answer would be C. Next one. Which of the following best explains the auditor's concern about short-term borrowings used for long-term assets? Aggressive tax planning wrong, creates a mismatch between assets and liabilities affecting liquidity. We discussed before, short term loans have to be repaid fast. You cannot use them for long term investments because their returns will come later. So it will affect cash flow. You will not get cash to repay those small loans or short term loans you have taken. So it will affect liquidity. So this would be the correct answer. This is the best explanation. It overstates profit artificially wrong. It improves current ratio. Cannot say these things. So B is the right answer. Third one. As a banker, which factor in P&L raises red flags about sustainability of MNO Limited's high profit level? So you have seen the profit level. Now they are saying whether it can be sustainable, whether they can repeat this profit year after year. What are the concerns? High depreciation charge, rising operating expense, high financial expense, adequate tax provision. So if you look at the again P&L statement, out of all those things, depreciation is 50, financial expenses 80, operating expenses is 200. So out of this, which is the most threatening to their profit? If you look at that, we can see that high financial expense is the most threatening because depreciation charge is less compared to the financial expense, and you will have fixed assets. That's where there will be depreciation. Rising operating expense also, you need to control it, but as the business expands, this will also increase. But you saw that almost 80 out of 150, their gross profit is going for interest payments. So this is a huge problem for their sustainability of profit. So C is the answer. Given the auditor's observation of increased sales return, which is most likely underlying issue. Sales return is clearly product quality and obsolescence. Considering the above data, what is the overall risk outlook of MNO Limited from a banker's perspective? Risk outlook. Let's read the options. Strong profit, low financial risk. Okay. Stable sales but risk of liquidity crunch, high leverage and product quality concern.